Is chasing depreciation always the best strategy for your investment goals? Today, I want to talk about a topic that generates a lot of questions from property investors: depreciation. It's often presented as a significant financial advantage, particularly when purchasing brand new properties or off the plan. Let's explore when it can be genuinely beneficial and when perhaps the focus should be somewhere else. Hi everyone, Amanda from Buyers Agency Australia. Now, before we get started, please remember that the information in this video is general in nature and for educational purposes only. It is not financial advice, so do make sure that you speak with your qualified professionals first about your own specific circumstances. Now, one thing to be really mindful of is that focusing too heavily on tax benefits such as depreciation, especially if it leads you to pay a premium for a brand new property, might not actually improve your overall financial position. Sometimes what looks like a benefit on paper doesn't actually stack up when you consider the total cost of the long-term investment picture. Developing a sound investment strategy involves looking at many factors, not just tax benefits. You need to also look at growth potential, rental yield, location fundamentals, and then of course, tax benefits after that. Tax benefits are a tax strategy, not a growth strategy. The growth and the viability of the investment still need to be there regardless of tax benefits. Now, if you'd like personalised help creating a strategy that aligns with your specific goals and considers all of these elements appropriately, please feel free to book a free, no obligation strategy session with our team via the link below. We can help clarify what's most important for your journey and how you should weight the different benefits when assessing what property is right for you. Now, firstly, let's understand what depreciation actually is in the context of property investment. Essentially, it's a tax deduction and it's for the allowance of decline in value of assets over time. So when talking about property, there are two main depreciable components. First, we have what's called capital works, and this relates to the building structure. So the bricks, the concrete, the roof, anything structural and improvements that are structural, such as renovations, new kitchens, new bathrooms, for example. Now, the tax office generally assumes that a building structure has a life expectancy of 40 years, meaning a house that has not undertaken any renovations for 40 years in original condition is probably at the point where it's due for a knockdown. So 40 years. You can typically claim a deduction of 2.5% of the construction cost each year over those 40 years. So the second type of depreciation is what we call plant and equipment depreciation. So this refers to items that are usually fixtures, things like ovens, carpets, blinds, air conditioners, part of the fit out that isn't structural. So a kitchen is structural, an aircon unit, plant and equipment. So these things tend to have a shorter effective lifespan. We don't expect an oven, for example, to survive 40 years. It may, but we don't expect it to. So these items depreciate faster than the building itself. A key point here is that legislation changed in 2017. So for residential properties purchased after May 2017, if the property wasn't brand new when you purchased it, you generally can't claim depreciation on the existing plant and equipment items anymore. Now, this often leads to confusion, and the argument that we tend to find coming forward from clients is that buying brand new is better for tax purposes because you can claim depreciation on everything after 2017. But we need to look a little more closely here. Does this advantage justify potentially paying a significant premium for a brand new or off-the-plan property? Often, developers price new properties to include their profit margin, their marketing expenses, and the newness factor. Now, this means that the purchase price might be considerably inflated compared to an established property in the same area, because not only is the builder making a margin on the build, they're also making a margin on all of those fixtures and inclusions as well. So you might gain a few $1,000s in depreciation from those extra fixtures in addition to the building, which you would get anyway, but have you paid too much for them up front? So you're depreciating what you've already paid too much for when structurally you qualify for 40 years on any property anyway. So you need to do the maths very, very carefully and make sure you're not prepaying your own tax deduction. Remember that land value is typically the main driver of capital growth over the long term. Buildings depreciate. Buildings are just simply the form of income. We can rent them out to hold that loan for us, but the investment is in the land. So with many new builds, particularly apartments where you own a smaller proportion of the land, a larger proportion of your purchase price is attributed to the building itself. So paying extra for the building to be the primary part of your investment to claim depreciation on it because it depreciates might mean you're compromising on the bit that appreciates, the bit that actually builds your long-term wealth. So when can depreciation be a valuable part of the strategy? It's most effective when it complements rather than replaces smart investment decisions and activities, particularly when adding value to an established property. When you buy an established property, for example, and you undertake renovations, like adding a new kitchen or bathroom or an extension or a granny flat, the costs of those capital works are depreciable and you still get the full 40 years even if the established property itself is older than 40 years. Anything that you create, replace or renovate is depreciable. Granny flats, extensions, kitchens, bathrooms, etc. The advantage here is control. You're choosing when to invest that extra money for the new bit to actively improve that property's value and rental income. You're controlling the cash flow, you're controlling the cost, you're controlling the timing, and most importantly, you're controlling the quality of the work and the inclusions and the fixtures. You are choosing them, not purchasing them from a developer. You are in control. And the depreciation that you can then make on those capital improvements becomes a helpful secondary benefit, improving your cash flow without requiring you to pay that profit straight to the developer instead of pocketing it for yourself. You can also strategically time these renovations and stagger the resulting depreciation claims over the years to suit your financial plan. So you might purchase a 30-year-old property, have 10 years left on it, new kitchen, new bathroom, you've got 40 years there. 10 years after that, you might add a granny flat or an extension. Stagger it. Then you maximize the benefit from a single property. So what this does is leads me to my most important point. Your investment decisions should primarily be driven by the goal of building wealth, not just saving tax. So you need to ask yourself, are the fundamentals of this property still there? Is the capital growth still there, regardless of the tax benefits? For example, does this property offer a good rental return? Is it in a fundamentally sound location? If you're buying off the plan and there are 100 house and land packages all due to settle at the same time and all looking for renters when they settle, you've just bought into a flooded market where there's not going to be any scarcity for renters. If they don't like yours, they'll go next door for the exact same floor plan. Same with units, 50 off the plan strata units, oversupply when they all settle at the same time, looking for tenants. So yeah, you'll get your depreciation, but will that property be rented? It has to be a sound investment regardless of the tax benefits. The tax benefits are the icing on the cake. So investing in a poor performing asset simply because it offers that tax deduction doesn't always make long-term financial sense if the fundamentals don't stack up regardless. It's important not to let tax drive your investment assessment decisions when tax is not a wealth building strategy. The fundamentals and the sound investment decisions is where the wealth building lies. So you need to focus on quality assets first. Now, with that being said, depreciation can play a role in improving the cash flow of your investment property, particularly when it's claimed on capital improvements that you've made yourself. However, it's important not to overvalue it if it means overpaying on a new property. Always focus on the bigger picture, long-term growth and overall return on investment. Now, if you'd like to discuss how to build a balanced investment strategy that considers growth, yield, and tax effectiveness in the right proportions for your circumstances, then please do reach out. Book that free, no obligation strategy session with Buyers Agency Australia using the link below. We're here to help you build a plan based on solid foundations. Now, I hope that gives you a clearer perspective on property depreciation. If you found this video useful and want to continue learning about property investment strategies, please click on one of the video previews on your screen to see more from our channel. Thanks for watching, keep learning, and I'll see you next time.